This session will cover cost sharing and program income. First, we will cover cost sharing. Cost sharing, or sometimes known as matching, is a portion of total project costs that is not provided by the sponsor. Under federal research proposals, voluntary committed cost sharing is not expected. It cannot be used as a factor during the merit review of applications or proposals, but may be considered if it is both in accordance with the federal awarding agency regulations and is specified in a notice of funding opportunity. Uniform Guidance Section 200.306 is where federal cost sharing requirements are detailed. Here are the types of cost sharing. Mandatory is required by the sponsor. This will be stated in the funding opportunity announcement. Voluntary committed is cost sharing specifically pledged in the proposal's budget or award on the part of the recipient. Voluntary uncommitted is effort that is over and above that which is committed and budgeted for in a sponsored agreement. Listed here are federal requirements for cost sharing. Number 1, are verifiable from the non-federal entity's records. 2, are not included as a contribution for any other federal award. 3, are necessary and reasonable for accomplishment of the project or program objectives. 4, are allowable under Uniform Guidance Subpart E cost principles. Additional requirements are as follows. 5, are not paid by the federal government under another federal award, except where the federal statute allows. 6, are provided for in the approved budget when required by the federal awarding agency. And 7, conform to other provisions of this part as applicable. Unrecovered indirect cost. Unrecovered indirect cost, including indirect cost on cost sharing and matching, may be included as part of cost sharing or matching only with the prior approval of the federal awarding agency. Unrecovered indirect cost means the difference between the amount charged to the award and the amount which could have been charged under the organization's federally negotiated indirect cost rate agreement. Values for recipient or subrecipient contributions of services and property must be established in accordance with the cost principles in Subpart E of Uniform Guidance. The value of donated equipment must not exceed the fair market value of equipment of the same age and condition at the time of donation. The value of donated space must not exceed the fair rental value of comparable space. The value of loaned equipment must not exceed its fair rental value. For third-party in-kind contributions, the fair market value of goods and services must be documented and, to the extent feasible, supported by the same methods used internally by the non-federal entity. Rates for third-party volunteer services must be consistent with those paid for similar work by the non-federal entity. Services must be valued at the employee's regular rate of pay plus an amount of fringe benefits that is reasonable, necessary, allocable, and otherwise allowable. An indirect cost at the entity's federal negotiated rate agreement may also be added. Now we're going to talk about program income. In the definition section of Uniform Guidance, it defines program income as gross income earned by a recipient that is directly generated by a sponsored activity or earned as a result of the award during the period of performance. Program income includes, but is not limited to, income from fees for services performed, the use or rental or real or personal property acquired under federal awards, the sale of commodities or items fabricated under a federal award, license fees and royalties on patents and copyrights, and principal and interest on loans made with federal award funds. Interest earned on advances of federal funds is not program income. Except as otherwise provided in federal statutes, regulations, or the terms and conditions of the federal award, program income does not include rebates, credits, discounts, and interest earned on any of them. Program income is not taxes, special assessments, levies, fines raised by a non-federal entity, proceeds from the sale of real property, equipment, or supplies, license fees and royalties for copyrighted material, patents, trademarks, and inventions made under the federal award subject to 37 CFR Part 401. Also, program income is not income that's earned after the period of performance. We'll look at the three methods or options for calculating program income: the deduction method, the additive method, and the cost share method. The deduction method. This method is a default method if it's not specified in the award document and the awardee is not an institute of higher education or nonprofit. Under the deduction method, ordinarily program income must be deducted from total allowable cost to determine the net allowable cost. Program income must be used for current costs unless a federal awarding agency authorizes otherwise. Program income under the deduction method reduces the federal contribution. Here's an example of the deductive option. In this example, $100,000 is the amount of the award from the federal agency. The recipient earns $25,000 of program income. That's deducted from the award amount to come up with the federal share of funds available, which is $75,000. The recipient's able to use the $25,000 of program income to further the program, giving a total of $100,000 funds available for spending on the program. The additive method is a standard for awards made to institutes of higher education and nonprofit research institutes, if not otherwise specified in the award. Program income may be added to the federal award by the federal agency and the non-federal entity. Program income funds are added to the funds committed to the project by the sponsoring agency and used to further eligible project or program objectives. This is an example of the additive method. The federal award amount was $100,000. The recipient earned $25,000 of program income. This is added to the federal amount of $100,000 to have a total of $125,000 that are available for the program. Under the cost-sharing method, program income funds are used to finance a non-sponsor share of the project or program, mandatory or committed cost-sharing. With prior approval of the federal awarding agency, program income may be used to meet the cost-sharing or matching requirements of the federal award. The amount of the federal award remains the same. This is an example of the cost-share option. In this example, the amount of federal funding was $100,000, with a requirement of $20,000 for cost sharing. The recipient was able to earn $10,000 of program income. This was able to be used toward the cost sharing requirement, which reduced the remaining amount of cost sharing to $10,000. Here is an example of program income that is not reportable to the federal agency. In this sample question, 3 months after the ending date of the Navy award, a follow-up conference was held. Participant fee was $500 each, and 100 participants attended, yielding $50,000 in conference fee revenue. Even though the conference was related to the Navy project, as it was held after the ending date of the Navy award, there was no accountability to the Navy.